Every major financial crash of the last 100 years followed the same sequence. Not a similar pattern. The same one. 1929 followed it. 1987 followed it. 2000 followed it. 2008 followed it. 5 stages. Always in the same order. Always visible months, sometimes years, before the collapse actually happens. Wall Street knows this pattern. The Federal Reserve knows it. The people who manage money for billionaires absolutely know it. You've probably never heard of it. Because if regular people understood what to look for, they wouldn't panic after the crash. They'd quietly step aside before it. Today, I'm going to walk you through all 5 stages and show you exactly where we are right now. Spoiler, we're much further along than most people realize. In September 1929, a man named Roger Babson stood at a business conference and said 9 words that made him the most hated man on Wall Street. Sooner or later, a crash is coming, and it may be terrific. The room laughed. Newspapers mocked him. And the most famous economist in America, Irving Fisher, publicly dismissed him, declaring that stocks had reached a permanently high plateau. 47 days later, the market collapsed. Fisher lost everything. His fortune, his reputation. He died in poverty. Babson made a fortune and went on to found a college that still exists today. But here's the part almost no one talks about. Babson wasn't guessing. He had built a systematic framework for identifying financial collapses before they happened. He tracked 5 conditions: credit expansion, market concentration, institutional behavior, liquidity, stress, trigger vulnerabilities. 5 factors, 5 stages. I spent months going through historical records, Federal Reserve data, and academic research to test whether this framework actually held up. It does. Every single time. Stage 1. The credit explosion crashes never begin with fear. They begin with debt. Before every major collapse, credit expands faster than the real economy can absorb it. People borrow money they can't realistically repay. They use the borrowed money to buy assets. Prices rise. Rising prices create the illusion of wealth. That illusion encourages even more borrowing. It feels like prosperity. In reality, it's a pressure cooker. In the late 1920s, ordinary Americans were buying stocks with just 10% down, borrowing the remaining 90%. By 1929, total margin debt equaled the entire federal budget. Factory workers were leveraged like hedge funds. In 2000, it was corporate debt. Companies with no profits borrowed billions, using inflated stock prices as collateral. When stocks fell, the structure collapsed instantly. In 2007, it was mortgage debt, zero-down loans, exotic structures, risk repackaged and sold to pension funds, leverage everywhere, just hidden. Now look at today. Official margin debt sits near $750 billion, and that number massively understates reality. Add securities-based lending, where wealthy investors borrow against their portfolios, another $800 billion. Add options markets, where small amounts of capital control enormous exposure, trillions more in notional leverage. Add corporate debt, now over $10 trillion, much of it used not to build businesses, but to buy back stock. Add government debt, over $34 trillion, with interest costs now exceeding the defense budget. Measured against GDP, total debt in the U.S. economy is higher than 1929, higher than 2008, higher than any point in recorded history. Stage 1 isn't flashing yellow. It's flashing red. Crashes don't happen just because prices are high. They happen because risk becomes concentrated. When a small number of assets carry a disproportionate share of market value, the system becomes fragile. It doesn't take a broad collapse. It only takes one crack in the wrong place. In 1929, the market revolved around a handful of glamour stocks. The most famous was Radio Corporation of America. RCA, went from under $2 to over $500 in a few years. People didn't understand radio. They didn't need to. The stock only went up. RCA became such a large part of market value that when it broke, everything broke with it. In 2000, the concentration moved to tech. Cisco, Intel, Microsoft. A few names carried the entire NASDAQ. When those stocks rolled over, trillions evaporated almost overnight. In 2008, concentration was hidden inside the banking system. 5 institutions held the majority of derivatives exposure. When Lehman failed, the entire structure nearly collapsed. Now look at today. The top 7 stocks in the S&P 500 account for over 30% of the entire index. At times this year, it's been closer to 35%. That means when you buy a so-called diversified index fund, you're not really buying 500 companies. You're making a massive, concentrated bet on a handful of mega-cap tech stocks: Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla. If those 7 stocks drop 50%, your index fund drops roughly 15 to 20%, even if every other stock doesn't move. And here's the problem. Those stocks aren't priced for good outcomes. They're priced for perfection. Perfect growth, perfect margins, perfect narratives. Any disappointment feeds selling. And passive investing makes it worse. Every dollar flowing into index funds automatically buys more of the biggest stocks. That pushes their prices higher, which increases their weighting, which forces the next dollar to buy even more. It's a momentum machine on the way up. On the way down, it reverses. Outflows sell the biggest positions first. Forced selling creates more selling. Liquidity disappears faster than anyone expects. This is stage 2. And we are deeper in it than at any point in modern history. Stage 3. The smart money exit. This is the stage no one likes to talk about because it exposes how the game actually works. Before every major crash, institutional money leaves first, quietly, methodically, without warning anyone. Publicly, they say everything is fine. Privately, they reduce exposure, raise cash, and buy protection. In 1929, the Morgans and the Rockefellers began selling months before October. Bernard Baruch was almost entirely in cash by September. Joseph Kennedy famously exited early, not because of his shoeshine boy, but because he had access to people inside the system. Regular Americans kept buying. They were the exit liquidity. In 2007, hedge funds were shorting subprime mortgage more than a year before the crash. Goldman Sachs bet against the same securities it sold to clients. Mortgage executives dumped personal stock while reassuring investors. Regular people kept buying homes and bank shares. Again, exit liquidity. Now look at today. Corporate insider selling is at levels not seen in decades. CEOs, CFOs, board members, the people who know the numbers before the headlines. The ratio of insider selling to insider buying is extreme. For every insider buying, multiple insiders are selling. At the same time, retail investors are pouring money in. 401k flows, passive index funds, retail trading apps. The smart money is selling. The public is buying. That is not random. That is the pattern. Stage 3 is active. This is the most dangerous stage because everything still looks normal. Markets are calm. Indexes hover near highs. Volatility feels controlled. But underneath, liquidity is draining. Liquidity is the oxygen of markets. When it's abundant, shocks are absorbed. When it disappears, markets don't fall. They snap. In 1929, the Federal Reserve tightened monetary conditions to curb speculation. Rates rose. Liquidity quietly vanished. For months, nothing happened. The market even kept rising. Then selling began, and there were no buyers. Stocks didn't decline. They collapsed. In 2007, the same pattern repeated. Rates rose. Credit tightened. Markets stayed high. Then Bear Stearns, then Lehman. And suddenly liquidity was gone. Now look at today. The Fed raised rates from 0 to over 5% in under 2 years, the fastest pace in 40 years. At the same time, it's been pulling hundreds of billions out of the system through quantitative tightening, yet markets remain near all-time highs. People think this means the tightening doesn't matter. They're wrong. In March 2023, 3 major banks failed in 1 week. Silicon Valley Bank, Signature, First Republic, victims of rate-driven liquidity stress. The Fed stepped in with emergency lending programs to stop contagion. Those programs didn't solve the problem. They delayed it. Even the U.S. Treasury market, the backbone of global finance, has shown moments of severe liquidity stress. This is stage 4. Everything looks calm, but the oxygen is leaving the room. Stage 5. The trigger. The trigger is the one thing nobody can predict, and that's exactly why it works. The trigger doesn't cause the crash. Stages 1 through 4 do that. Debt loads the system. Concentration makes it fragile. Smart money exits. Liquidity drains. The trigger just lights the fuse. In 1929, it was a minor British fraud case. In 2008, it was Lehman Brothers. Neither mattered on their own. The system was already primed to fail. This time, the trigger could be anything. Geopolitical, financial, banking-related, political, or something no one is watching. History shows that when stages 1 through 4 are active, the trigger usually arrives within 12 to 24 months. Those stages have been in place since late 2024. That puts the window in 2025 or 2026. The only part that matters, this doesn't mean a crash happens tomorrow. And it doesn't mean panic. It means the conditions that preceded every major crash of the last 100 years are present right now. Roger Babson saw the pattern and prepared. Irving Fisher ignored it and lost everything. The people destroyed in crashes aren't stupid. They're unprepared. No one warned them in 1929. No one warned them in 2008. No one is going to warn them now. The warning is the pattern. And now you see it. What you do next is up to you.